I'm Keith McCullough. Welcome back to the final leg of the Investing Summit, where I get to tell you what I think is going to happen. All right, we've already said what we think is going to happen. This actually has started to play out. We call it Quad 4, okay? Quad 4. This is not a Cat 4 hurricane. This is a Quad 4 hurricane. Quad 4. So what I'm going to do first is walk you through what that means. Secondly, I'm going to walk through many of the reasons why we think we're early on this, and moreover, why it started working so quickly. So first, let's just jump into the process. I'm going to do this in maybe 15 or 16 slides and then take your questions. But again, this is a part of a presentation we made 3 weeks ago. It's called our Q4 Macro Themes Call. And again, we called it Quad 4 in Q4. So again, we didn't think that this should start to play out until we got into the fourth quarter. But I digress. First, on the process, okay? So slide 5 here in the macro deck shows you what we do versus what they do. So I'll get a lot of questions on, well, this person thinks that, and that person thinks this, and this macro tourist is talking about tariffs and Trump and this and that. Well, I don't do that, okay? What I do is focus on the rate of change, okay? This constant measuring and mapping on the right side, the second derivative. For those of you who took calculus in high school, obviously you know what that is, and we do not think it's that complicated of a modeling premise. What is complicated is understanding the old wall and their consensus, which largely starts with valuation and what the world should be. Whereas what I'm focusing on is nowcasting, or being highly data dependent here, exclusively data dependent, on what is happening. So again, it has nothing to do with politics, it has nothing to do with theories, it has to do with what the data and the market is actually doing now, okay? So if you look at the next one, this looks a little bit busy, but any model should if you built it on your own. But again, 4-quadrant model. So when I say Quad 4, what I'm saying is what I care about most, and this is not subject to a lot of contention, I don't think. Ray Dalio's built a wonderful firm with a lot of people who have backtested this, but growth and inflation are the two biggest and most important factors to solve for in macro, okay? The rates of change of growth and inflation. So when you have growth accelerating and inflation accelerating at the same time, as you can see for the last 5 quarters, the U.S. economy has been in what we call Quad 2. I'm highlighting with boxes where the U.S. economy was in each, again, of those quarters. And again, that's not subject to opinion. That is a fact, okay? Moreover, the opinion is that we're going into Quad 4 and Q4. That is indeed a forecast, but it is based on our model. Okay, so Quad 4 is when you have both growth and inflation slowing at the same time. Quad 3, of course, is once you have that, central banks realize it, the turntail, they go dovish, they try to devalue the currency, and what you get is some asset price inflation, most specifically assets and markets, but you don't get economic expansion, you get stagflation. So Quad 3, for example, is called stagflation. But again, to remind you, we've been in 9 consecutive quarters. It's a new U.S. record. 9 consecutive quarters we've been in Quad 1 or Quad 2. That includes growth accelerating. So if you wonder why people are bullish on bond yields or bearish on long-term bonds, this is one of the oldest stories in the history of the U.S. stock market in terms of consecutiveness. Do you know, looking backwards, that inflation went up? Of course you did. But again, that is, again, yesterday's story. What I'm trying to do as a risk manager is prepare you for what the most amount of people are not positioned for tomorrow, okay? So that's what we want to do, and we want to get the timing right on that. As you can see here, and this is a lot of data as opposed to just spewing like a lot of people do, which I just listened to one in particular on Old Wall TV, because I just want to make sure I could hear what he was saying. The reality is that what the data says is much more important than what any human says. So in the first 4 columns, you see the quarterly returns by asset class, subsector exposure, factor exposure in all 4 quadrants, okay? So my process is pretty simple with a lot of complexity around it, but the simplicity of it all is figure out which quadrant you're going to, and you have a playbook at the sector level, at the factor level, which includes something like momentum, which we're currently short. Again, that's what I do. It's very consistent. It's not qualitative, as I pointed out. It's apolitical, and it's data dependent. Next chart. So we also spell that out in words. You can see in the 4th quadrant, it's literally the mirror image, or it's the opposite, really, the reflection of Quad 2. So in Quad 2, which our call was, and hopefully for those of you who followed us for a long time, you know that I've been bullish on U.S. growth for the last 2.5 years and bearish on long-term treasury bonds, because that's what Quad 2 says you should do. We were bullish on momentum, high beta, technology stocks, consumer discretionary. Now I just want to short all of it. okay? Because in the fourth quadrant, that's exactly what you do, and you get long dollars, you get long duration, i.e. long-term bonds, utilities, consumer staples. You can see the factor exposures. Minimum vol and high quality is what your portfolio should look like. So in the last 3 days, or really in the last 3 weeks, if you did that, you absolutely crushed it. And don't forget that that's your job, especially if you're running institutional money. If it's not your job and you just care about your own money, I suggest you have done that too. All right, the next slide. Again, we do this around the world. So I don't just wake up in the morning navel gazing at my political views of Trump or some other political candidate or otherwise. No, I look at the world in the same way across all those different countries. If it looks busy, it is. If it looks like it doesn't have a lot of words, it doesn't. What it has is numbers. Numbers, numbers, numbers. The rates of change of those numbers, if you get them right, you will get macro markets right fully and again, happily along the way when consensus is illy positioned for that. Next slide, if you look at, just to finish off, the actual nowcast is after 9 consecutive quarters in a row. So again, what we do is we run predictive tracking algorithms that are highly accurate, certainly more accurate than anything else you see published on the old wall, but that's not much competition. Where we do have competition is on the buy side, okay? So clients have their own forecasts, plenty of buy-siders. Jeff Gundlach in particular, he has one on inflation that is contra to mine, which I'll go through in a second. I have my own model and I have my own data that is not subject to my own privacy. I mean, it's publicly available information. But we have GDP slowing for the first quarter in the last, again, 9 quarters in a row of acceleration from 1.3% year over year back in the middle of 2016 to 3.x% here at the peak of the cycle, down 30 basis points or thereabouts. Now, you might say 30 basis points isn't a lot. I don't particularly care what you say on that. It matters. Okay, if you look at that in terms of how Wall Street will read it, the sequential reading, which we're showing right here, by Q4, the GDP number, we have it going to 1. Not 3, not 4, 1. And we were the firm that kept saying we were going to go to 3 and lock in multiple 3s in a row, and we did. Okay, so again, I'm not painting both sides of the fence. I do go both ways, however, and when the data is about to roll over into steepening base effects, we make this call. So again, GDP 4.2, that's yesterday's news. 3 point, wherever we wind up for the third quarter will be yesterday's news. The fourth quarter will have a 1 in front of it if our numbers are right, and that is a drastic difference versus Wall Street expectations. Moreover, that's just growth. Inflation, okay? Inflation, and this is where I deviate, and meaningfully so, from Mr. Gundlach. And I will call you Mr. You won't call me Mr. McCullough, and I don't mind. But we are playing against each other in this arena, and as a 43-year-old man, I have some pride to tell you why I think I'm going to clock you on this one. This is what I think, okay? Because this is my process. I have a view that inflation has peaked. All right. Whether you look at today's PPI data or yesterday's PPI producer price information, that was the 3rd consecutive month of a slowdown already. Okay. So that's not an opinion. That's a fact. Okay, Mr. Gundlach, that's a fact. In as much as this morning, the headline CPI number slowed again to 2.3%. The peak was 2.9%, and that was the July number, which you can see in that chart if you go back to it. The quarterly number is around 2.8, but the July number, by the time we get to July of next year, the inflation numbers could be really low, okay? I'm just calling for the first 100 basis point slowdown in headline inflation to 1.82%. You can see that that's our predictive tracking algo ticking that way here in the blue bar, whereas Wall Street is still kind of sticking with the forecast. This is what Wall Street basically does is they take what happened yesterday and they pin that across as the future. And now, if you've ever used Wall Street consensus on growth and inflation forecasts, I apologize for that. Hedgeye is a relatively new firm. We started the firm a decade ago. We started it by calling the financial crisis in 2008. We also called the bottom in 2009 in the U.S. stock market. There's been plenty of calls that we made, but I'd much rather focus you on the process as opposed to that history. Okay? So the history is that we've used base effects as the most predictive value. Again, it's much more powerful than the intellect or the collective mind share of consensus. We all know that everybody on Wall Street is really, really super smart, okay? This is so easy, a hockey player could do it, I assure you. I had the lowest SAT score at Yale, okay? Lowest, not in the middle, not at the top, at the bottom, okay? What I figured out, and maybe I came upon this in happenstance, because I wasn't, following my own belly button around the campus. But what I found was that the most predictive value, backtesting all the data, is what's already actually happened. 78% of the time. 78% of the time. You want a backtest? Here's your backtest. 78% of the time, the forward outlook should reflect the inverse of what already happened. Okay, so that's your first assumption. So as you can see on this chart, whether you're looking at the left side, which is the comparative base effects or the comps, for those of you that know what that means, think of a retailer, for example. They have year-over-year same-store sales or the comps. The comps are only going to get more difficult for the next 4 quarters from here. So all things held equal, whether you're a Republican, a Democrat, a bird, or a dog, that is a fact, okay? You're going to have to get faster, incrementally faster growth than what you've already had for 9 consecutive quarters in a row. And by the way, 9 quarters in a row is the new record. The prior record was coming out of the 1991 recession at 7 quarters in a row. And on the right side, comparative base effect model tells you again, if your outlook is for more inflation after you've already had a 3-year high in inflation, well, you're going to run into a wall, which is called the comparative base effects, which I highlight there in red. Now, here's what the data looks like if you're into measuring and mapping in rate of change terms. Not everyone is. And again, if you disagree with me, I completely respect that. But please respect my process, or at least attempt to understand it. I think for too long, too many people have not actually taken the time to understand the math behind this. Now, as you can see, the color coding of this should make it pretty easy. Even if you're not mathematically oriented, you should be able to understand the momentum of data. It was really red, okay, coming out of early 2016. That was the low of the cycle. Then it went yellow. Okay, it started getting a little bit better. Then it went kind of lime green. Then it went bright green. Okay, so Q318 is about as good as it gets in our model. The forward outlook is that we go back to yellow lights. Yellow lights. So if you wonder what are the big drivers, the next picture can tell you. Retail sales, or the control group. It might be the next slide after that. If it's not, I'll come back to this oil chart. But retail sales in particular had a monster Q4 of last year. That's why if you go back to the prior chart, you could see the control group of retail sales had a massive contribution to GDP. That was during tax reform. Also, so Q4 of 17, extremely difficult comparison on its own. If you go back to Q4 of 16, which is the real key here, 16 is, again, it wasn't just about Trump. In fact, it might not even been about Trump. But at the end of the day, you had the Q4 Trump acceleration. So you can see retail sales had two fourth quarters in a row of massive acceleration on any historical precedent. So unless you think that the U.S. economy has the capacity to see retail sales go 5, 6, 7% against comparisons that are going to go up by 200 basis points, then you're going to be agreeing with me. Okay, you're going to be agreeing with me, which given the politics out there, at least 50% of the country would probably believe anything I'm saying right now anyway, because they want to see Trump implode. Okay, so one more chart. I think we might have a couple. Actually, on oil, I want to make sure I make that point because we'll have questions. Oh, Keith, but oil's up, therefore inflation's up. Well, that's true, but don't forget that oil's been going up since it broke out in September of last year. So again, to get inflation up from here, okay, Mr. Gunlack? From here, and I've met with his research team. I know what his team does, and I know what mine does. I'll take mine, okay? You'd have to average quarterly Brent oil 89, 97, and $109 a barrel. That's just to get the oil component or the energy component of headline inflation to comp the comps, okay? What about tariffs? Everybody's like, oh my God. So a lot of this starts with, I'll be darned if it isn't the political opinion. This is gonna come home to roost. This deficit and all the while, they forget to just simply tabulate what I highlight back, go back one more. The red writing in the former chart that says, it's the dollar, stupid. So again, there's this one firm on Wall Street that said the dollar was going to break out in April. That was us. And the dollar impact to how tariffs are stated as an inflationary or a disinflationary measure has actually been the muter. It's been muting inflation. Again, CPI and PPI, which were just reported in the last 48 hours back to back, disappointed Wall Street. So if your premise was inflation was going to go up, and it didn't, I dare ask you, as the facts change, do you change your opinion and your positions? Okay, so there's a lot to think about there. The last slide I want to show you is slide 54 in the current macro deck, which again summarizes the world. So if you didn't have the view, which we did, obviously, maybe not obviously to people who are, this is free, by the way, so maybe we have a lot of people that like me or don't like me listening. I thank you all for joining. Any kind of space inside your mind is what we're trying to get here. We do not want you to be hostage to the old wall. We don't want to be hostage to advertisers or people pushing their own books. We want to be, again, in the future, hostage to the data dependence of it all. So what you can see there is the fourth quadrant, as I pointed out at the beginning. We're going there in the U.S. for the first time. As you can see on the U.S. line, it's 2, 2, 2, 1, 2, 2, 2, 2, 1, 2. So those are quads 1 and 2. The next 2 quarters we have them in quad 4, and guess what? The world already went into quad 4. These are the top 20 countries by GDP, scoring them in rate of change space again. Not an opinion, it's a fact. Okay? Looking backwards, you can see that the globally synchronized recovery ended when Hedgeye said it would, which was in the first quarter of 2019. That's why we said China would slow, emerging markets would slow, and Europe would slow. Now back then, all 3 of those places slowing, we'd get a lot of you and clients and prospective ones saying that's interesting, but it's not happening yet. Now 100% of clients and you agree that China's slowing, EM's slowing, and Europe's slowing. So how many of you disagree with me that inflation and or growth in the US is going to slow? I would vouch that a lot of you don't agree, or at least you didn't coming into the prior 3 days of this decline, or the last 3 weeks for that matter. I guess one more thing that I just want to highlight when you're in quad 4, the things not to be long, slide 70 in the current macro deck. The things not to be long in the US stock market, just talking about US stocks, I've talked about bond yields and the dollar so far. Momentum, high beta, and technology, and then the Russell. Now, what if you were long all 4 of those things? Oh, that's a problem. I mean, those are the worst places you could have had your money coming out of the Hedgeye Macro Themes call. The worst, okay? We don't want you to be the worst. We want you to be first. How's that for a cheery message? Let's take some questions.
All right, bunch of questions here.
I hope so. I'm looking forward to this.
Okay.
I got a lot of time for questions too.
All right, Keith, could you explain how you might go about balancing a portfolio of longs and shorts based on your growth slowing outlook?
Yeah, sure. Go back to slide 8 and print that out at home. Color printer is preferred. And again, you can just read it in print. Our playbook is pretty simple. When I tell you where we're going, so when I say we're in quad 4, especially if you're running global long short, there's plenty that you should be doing there. Again, your equity sector overweights and underweights are there. Your style factor overweights and underweights are there. You should be long duration, as I pointed out, and you should start to be underweight things like tips.
Okay. What are the bulls missing right now? What are the big catalysts behind your U.S. economic outlook?
Again, we just went through all that. I think that's pretty straightforward.
What happens to your outlook if the Fed goes dovish?
Well, that's great. I mean, then they'd agree with us, and bond yields will be falling into that. Don't forget that the Fed operates on a lag to lagging economic data. Okay? So your job as a risk manager of the market is to not get the market front running you. My job is I don't particularly care what another strategist thinks. I care about what the best strategist, actually there's one, Mr. Market. Okay? So Mr. Market's constantly front running you. And having been in a position where I was bearish on bonds and bullish on bond yields for so long, and bullish on U.S. growth and U.S. growth stocks for so long, is that I'm just letting the market lead the way alongside the data. So again, that's what you're looking for every day is confirmation or refutation or denial. In this case, again, if you're a gunlack today, you got to say to yourself, well, if you're looking for a higher inflation number, why didn't you get it? You got to fix your model, or did you just did you call for that? I don't know what you did. But if it was me, that's what I'd be asking myself. Moreover, if the style factors that shouldn't be working on the long side in the 4th quadrant weren't working, I'd say to myself, well, what the heck's going on here? I mean, if you look at utilities versus tech, I don't know if you guys can throw up the bongo board, for example. Bongo board being the sectors, just looking myopically at the U.S. stock market. Of course, we have to look at all stock markets, bond markets, currency markets, etc. But month to date, I think it's pretty clear. Utilities are up 2.56% and tech's down almost 8%. So the market's starting to agree with me, and actually in very short order. And I think that again, it typically happens when the most amount of people are improperly positioned at the most improper time, the most amount of money is lost. Most of what I built in terms of my model is by getting smoked, okay? You don't want to get smoked. If you got smoked in the last 3 weeks or last 3 days, you got to ask yourself, is there a better way? You got to ask yourself that, because everything that I built, don't forget, the first 10 years of my career or thereabouts was on the buy side, and then the last 10, God willing, I've been in the fishbowl trying to explain to people what I do, accountable to every single move I make. And again, it's made me better because I get more feedback, I get criticized intensely when I'm wrong. I almost can't be wrong, but of course I am wrong a lot. And when I am wrong, I make the process better. So again, a lot of what we're showing you today has to do with a very rigorous process that's built on a lot of discipline and a lot of experience, and certainly a lot of data.
Okay, a couple questions on gold. The first is specific to today. Can you deduce anything from today's gold price action strength as a result of yesterday's equities market sell-off? And then an add-on to that is Can the dollar be strong and gold be strong at the same time?
Yeah, it's an important question, and it really is important to understand that what's happening in front of you today can really impact your view of what might be happening tomorrow. Now, if you broaden your horizon a little bit and look at what's been happening for the last 3 weeks and 3 months and really 3 years, these are the durations that we really care about in our process deck. You can see we call it our trade trend tail model. Gold's been bearish on all 3 durations this year. It's had tail risk, obviously. Why is gold up today? I mean, the dollar's down today. It's got a 90% inverse correlation to the dollar. So you want to see the up days that gold's had, particularly in the last 3 months, been dollar down days, okay? So that's one thing. Gold over time will get much more interesting. When the Fed goes whole hog dovish, you want to be long gold, okay? You also want to be long gold as opposed to what the call we've been trying to make now is that bond yields are done going up and that they're about to go down. When they're actually going down in free fall and the Fed is cutting interest rates, that's when you're long gold because the real yield, again, gold competes with real yield. If real yield is rising and the dollar's rising, well, screw gold. Vice versa. If you have real yields falling, gold's got no yield, okay? So it becomes more attractive. And in dollars, it certainly becomes more attractive. I understand that you have a lot of people that have told you a lot of things about gold. You can look at my long-term batting average trading gold on the long and short side going back a decade. Every single position's been time-stamped. Same thing with the dollar, and I trade them in kind. It's about 80-something%. I don't know what it is, 81, 82. If it's 79, who cares? Okay, so there is a process to go both ways on all things. Please don't fall in love permanently with any asset class, gold included.
Any thoughts on volatility? Do you see volatility rising further or falling?
Continuing to rise. Our call this year has been that we're going to get a breakout in global, cross-asset class global volatility. I don't know if you guys can show the update from this morning, Josephine. On the macro show, by the way, we give a daily stat pack that shows you all the stuff that I'm looking at before I go to bed. Before I go to bed, that's what I do. I don't do what Elon does. But at the end of the day, I'm not, maybe it's because I'm not that rich. Even if I was, I'd still do the same damn thing. Boring it is, but this is the data. You can see just a massive breakout in both implied and realized volatility. Now you're seeing big implied volatility premiums across the base after we've had 6 straight down days in the U.S. stock market. That again is not a conceptual surprise. But again, what we've always assumed is that we can't predict the next cluster of volatility, or what Benoit Mandelbrot or anyone who's oriented fractally in terms of how they look at markets, which is of course my training and what I do. That volatility is episodic and non-trending until it's trending. Okay, episodic, you know what the word means. An episode of vol, boom, then it goes away. Then it goes boom, boom, boom. Then it starts to trend. When it starts to trend, when volatility starts to trend, fish on, short seller. Okay, fish on. Now your job is to not lose the fish. Okay, as a Canadian fisherman, you're starting to get in sync with me, aren't you? At the end of the day, that's what happens. Once the fish is on, it's bad day for the fish. Okay, so that's the whole thing about volatility and assets. When volatility breaks out, the fish gets caught. You're dead. You're out. So that's what we want to get ahead of. We do not want to be the person who is, again, getting caught offsides all the time in that regard. If you go on the macro deck, we'll just show you just kind of like a process-oriented step up on this. Maybe I could even actually draw on it, just to help people understand, Jonesy, what I mean by that. A lot of people look at the market on slide 22. A lot of people look at the market like in terms of, well, if I look at the 50-day moving average, or the valuation is attractive. I mean, all this stuff is just complete bullshit. At the end of the day, it's true bullshit, but it really doesn't help you. I have 4 kids, almost all 4 of them. My 3-year-old may not be able to do it yet. They could tell you where the 50-day moving monkey is. Of course they could. They could tell you what the multiple is on any stock that's called Yahoo Finance. So at the end of the day, a lot of these perceived wisdoms have no value. The context of what's happening to price, volume, and volatility absolutely does. All right, so if you look at this, like our model, if you can bring that back quickly, our model really focuses on these 3 things, okay? So I say price, volume, and volatility. What is the best predictor of future price? I already highlighted that. That's why we overweight volatility. So what I want to start doing is get into the vectors of volatility. What is implied versus realized doing? What is the surface of volatility doing? What does dispersion look like? What is the term structure of volatility? If all these things they shouldn't sound complicated. We should be competent. You see a very broad, and you can see, obviously, they don't like me because I call it out. You have people who are alleged experts across everything global macro and markets these days that couldn't tell you one iota about what I just said. 0. And I'm not trying to talk over you, below you, or I'm trying to talk with you. This is, again, 2018. there has been very little to no innovation or revolution in our profession. And I'm trying to help provide it. And we have a lot of people that are contributing to this, including very sophisticated clients, all of which you would know, that have very good returns, by the way. And a lot of people don't. So again, there's a lot to think about here. But again, don't just think about the surface area or the moving average single factor model of price. Price, volume, volatility, and all their relationships. Look at what happened to volume yesterday. Josephine, do we have that again from this morning? So when price is going down and volatility is breaking out, what happens? Does the volume or does the conviction of the market agree or disagree? Yesterday's volume versus the 1 month average was up 40%. 40. You bet your Madoff people you had some conviction with their sales, and that's probably why this morning's bounce in the U.S. stock market lasted about 20 minutes.
All right.
We're going to get a bounce, by the way. If you're looking for a bounce, it's going to happen at about 3:17 p.m. I have no idea when it's going to happen. But we're getting close to the low end of the range. People are just, completely choking all over themselves and puking here. Don't forget it's tap on the shoulder time for people that are at pod shops or hedge funds where they have a boss. That tap on the shoulder is like, I got one. I got fired in 2007. Know exactly what it's like. Pack your bags, buddy. Had to go tell my teammates we're out. Got fired. Yeah, that I learned something from that. Unlike a lot of people, that talk to you on TV, they won't get fired for any view that they have. Absolutely not. And if I screwed up at Hedgeye in the last decade, you would have fired me too, because you have to pay for our process, and people wouldn't pay for something that doesn't work. Okay, so the tap on the shoulder happens when the drawdown in your portfolio can no longer be sustained. So what's happening here is that you have a very narrow door of liquidity for people to get out of, and everybody has to get out at the same time. Now the machines are perpetuating this. 80 plus, actually it's 90% almost at this point of daily trading is called systematic. So again, it's the machines. Don't blame the machines. Understand the machines. Understand the machines. Step number one. Everything that's behind me here that I just went through, price, volume, volatility data, a lot of that stuff is really causal in causing taps on the shoulders.
This is to your point on things bottoming or the potential for a bounce. Is there more pain in emerging markets? Is the bottom near?
No. I mean, we've been a short seller of every bounce. Again, the way that we define a bounce is it at or not the top end of the range? So every day we publish what we call the daily trading range for pretty much all the big things in macro. And every time we get to the top end of the range and things in like Turkey, Brazil, you pick anything that we've been shorting this year, it's really a short sale. And if we change our mind on that, you'll hear me say it first. Again, we do this every day. We do it in print, we do it in tweets, we do it with a video. We don't hide. There's no hiding in hockey, okay? There's no hiding in this game, and that's the game that I'm playing now after playing a lot of hockey. So again, we're open, honest, and transparent, obviously, about everything that we do. The day that we make a call that emerging markets are no longer short, we'll make that crystal clear.
Okay.
Any questions about Gunlack? People get a little upset about that. They think that I'm like personally attacking them.
There is, hold on. Oh, we'll go to this one. What does bongo mean?
That's funny.
You've mentioned healthcare a lot for Quad 4. What ETF do you use for evaluating healthcare? PPH, XLV?
PPH and XLV are the two. Pharma is PPH and XLV is the sector ETF. So back on the bongo board, you can actually see, and again, our playbook says healthcare is one of the top 3 places to be in Quad 4. What's the best performing sector in the stock market for the year to date all of a sudden? Healthcare. Look at that. Magic. One guy on the old wall at his media outfit said that I just make things up. You typically accuse people of doing what you do.
So this is more of a comment about Gunlack rather than a question. Gunlack is out there spouting higher inflation. Oh, he just said he's a math major and he should have some credibility.
Oh, wow. Well, that's great, Jeff. I've met with him. I actually went through, I got a lot of respect for Jeff Gunlack, obviously, and all of his accomplishments. I'm talking about his professional accomplishments. But at the end of the day, I think that if you look at his views, and I think my team's math is better than his math, so how do you like that? I don't think he's crazy. I just think that he's pushing his book at the end of a move. And that's exactly what he should be doing. You got to bring in those assets. You got to tell a story that you've been telling, which he has been, by the way, and I did too. What's interesting about he and I is that we've had the same view. and I'm the first one to turn. I'm also the first one to say short emerging markets while he stayed long them. So I guess my math was better on emerging markets than his. That's just this time. I got a long career ahead of me, God willing. I know that I'm a little younger, and I know I'm probably a little shorter, and I'm probably going to be a lot fatter, but it doesn't matter. You got to make a call. This is the spot to make a call. And imagine that. David Mucker, whatever you want to call me, throw an F in there instead of my nickname. Against Goliath Gunlack. It's a moment. That's exciting. I love that. I mean, who the heck am I, right? I mean, at the end of the day, I had one guy in Old Wall Media today say, Keith, we ignore Keith. We being the backslapping community of the Old Wall Media outfit that, again, Gunlock participates in. But again, there's assets to be raised. There are products to market. Let's just get to the point of the matter. Why does Mucker think he can beat the Goliath Gunlock on this call? There are three big reasons, if you just want me to summarize his interview that he just did on Old Wall TV. Three big reasons why he thinks interest rates are going to go up. One, because they've gone up. Okay, that's one. The Fed is raising rates. Okay, we got it. That's about 3 years old. He knows that. And we've done it 3 times, by the way, this year, and we're about to do a fourth. And that's been our call. I totally agree with that. Number two, there's a lot of debt. Heck, there's a lot more debt than there's ever been. And there's also a big deficit. That's probably the most interesting one that I can't quite put my finger on in terms of having its causal factor. I'll give that one to Gunlack because that's the one that I'm not as concerned about. But his concern about that might be more worthy than mine. Again, this is Goliath. I'm just little David. Okay? Third one, inflation. He thinks it goes higher. I think it goes lower. I think that's where the payday comes. So again, let's call one a known, raising rates, no shit. Number two, an unknown. And number three, a known. And the known by me is saying inflation is, i.e. just fell today, it fell yesterday too, and it's going to continue to fall in the coming months. And within a year from now, I bet you Jeff Gunlack's telling you that the bond market is going into its next bull phase. If I'm right on that. The number one predictor, as Jeff knows, for long-term bond yields, the number one predictor, he talks a lot about the back tests. If he's doing math, he's absolutely going to tell you this. The number one predictor of bond yields long-term is inflation and its expectations. That's why he's short the long-term bond, because he thinks inflation goes up, and I think it's going down. Game on, brother.
All right, if the global peak was in Q1 2018 and the US peak was in Q3 2018, does your model anticipate foreign markets leading the US out of Quad 4? So do you have the, I guess, foreign
economies? Yeah, good. I mean, that's actually an important, really astute observation. If you go to slide, guys, can you throw up slide 54 just to show the, this would be called like the command, really the command central of the Hedgeye process, okay? So when you make that point, they said Europe, right? In the question, they say Europe?
Yep.
Okay, good.
Well, it said global, but yeah.
But if you go, so here, if you look at what slowed first, I mean, if you look at Spain's a good example. Because in Q3 of last year, we told people to get out of European equities. As you can see, and by the way, 1s and 2s are good, quad 1 and 2 are good, 4s are really bad, 3s are bad too, yellow lights. But again, 4s, you go to Spain, it's like 4, 1, 4, 3, 3. Okay, so that's basically what European stocks have similarly tracked. Don't forget, if you go to the Eurozone itself, just as a summary, 4, 4, 4, 3, 3, 4. Okay? The USA, meanwhile, it's all 2s and 1s, all these here. Okay? That's why the US outperformed Europe. That's why the Hedgeye call to be long US growth and short European equities across the board worked. Okay? Similarly, that's also why long US equities, short emerging market equities work. Because if you look at countries like South Africa, 4. Mexico, 3, 4. Russia went to 4. South Korea, 4. Okay? This was all coming out of this part. Okay? So again, the question is, the things that go to the 4 first, aren't they the most logical to come out of the 4s first? Yes. Because economies, unlike companies, well, some companies are, but some companies aren't, are mean reverting. Okay? They're mean reverting. So there is a chance here, especially if the ECB goes as dovish as they should, that I'll want to get long Spain, for example, or the things that I haven't liked the most for the longest period of time. Okay? And again, this is highly data dependent, so every day you got to, God willing, 2 feet on the floor, you rinse and repeat that data. I know I can outwork a lot of the teams out there that have differing views on this. And this is really not about just outworking people. It's about having, again, a delineated process that is truly data dependent. It's not about raising money. It's not about any kind of thing other than being right. And that's what I want to do. And there's no time to do it yet. In fact, if anything, the European data has slowed at a faster rate than even we would have thought, even though we were the first ones to go bearish on Europe a year ago.
Is Japan now in a bearish trend?
Just broke today. Japanese equities did, so that's again, you get a 3.9% drop in the Japanese stock market. That's going to change the math for those of you that do math. But again, the real thing that happened in Japan wasn't just the break of price. Given our trade trend tail signal is price, volume, and volatility, it was the volatility component that broke out to bullish. So when you go bullish vol, you're bearish trend. Effectively is the way that the math works in our model. So that was one of the few places that was left. There aren't that many in the world in terms of being long stocks. And quickly they're going away. In fact, if you look back to even 3 months ago, there are a couple other places that you could have stayed long equities. Again, not shockingly, our model called this. One was Australia, again, twos and ones are better than threes and fours. Another one was India, 2. Oh, then it went to a 4. Indian stock market goes down 10%. Again, this isn't magic. And this doesn't mean I'm going to get it right 100% of the time. This just means that I'm more probable to get it right more often than the other people you're listening to. Okay? I know the alternatives that you have out there on macro are bad. I mean, God knows if you look at the returns of macro hedge funds for the last decade, those are bad. So we're trying to give you a probabilistic outcome. Okay? What is the most probable place to see problems or to see some kind of a prosperous environment after having problems? That's what this model is set out to do. And with very high batting averages, that's exactly what it does.
So right now it seems like quad 4 versus monetary tightening. But if Powell keeps on this path, then at some point he blows things up. Or does he come to his senses and start to ease? Either way, lower rates, correct?
Yeah, I mean, the bond market just told you what it does when the world goes straight upside down. I mean, the best catalyst for falling bond yields is me being right on everything else.
Yeah.
Ta-da! I mean, look, the 10-year yield, I mean, fully loaded with Gunlack, getting a full, literally, he was allowed to push his book with no commercial, just like I am now. That's why I built this channel, because I get to say what I want, when I want, and I don't have to have some bloviating journo like interrupt me. But at the end of the day, that's okay. That's okay. You're going to see, with his fully loaded, again, I don't know what you want to call it, but he laid it out there. Bond yields didn't move. You're talking about Goliath. If he can't move bond yields with that kind of airtime, I'm wondering what's going on here. Again, bond yields are 316 here on the 10-year. 24 hours ago, they were almost 10 basis points higher than that. I think it's because the data, don't forget, CPI and PPI were reported. And as markets fall globally, markets start to say, hey, look, what is the best allocation I can go to when I can't own anything else?
Yep.
This is, by the way, the history of markets, and Jeff knows that too. Enough about Jeff. This is about us. It's about you. It's about your, where are you going to put your money? Where are you going to put it? Some Zimbabwean currency, a crypto maybe? What are you going to do? You put it in the world's reserve currency, dollars, or you buy U.S. Treasuries. That's the whole point. In Quad 4, what is the highest expected value in Quad 4? Hey, we got data for that too. Us math guys, and we should be sticking together. Should be making this point over and over again, really. If you look at, let's see here, where are we? I got the back test on my, I'll find it. Eventually I'll find it. Actually, it's in the back here. Okay, go to slide 68, please.
There we go.
There you go. So what do you do in Quad 4? You don't buy growth. You can see the expected value of the Russell 1000 gets hammered in the fourth quadrant. Value might work, but barely. It's only a relative story. Value goes down more than bonds, stay flat or up, and dollars go up. Next slide, slide 69, Quad 4. You also take down the beta and the volatility of your portfolio, and you get longer of dividends and yield. So that's why utilities have done so well. At the factor exposure level, again, if you go to slide 70, I already made my point on that. But again, the biggest thing that works actually in Quad 4 is actually long-term bonds and the dollar. So really, long-term bonds, when do you think they would work? I mean, they work when growth and inflation is slowing. That's why long bonds exist. That's why that asset class exposure is perpetuated by those two causal factors. So again, Jeff Gunlack would agree with that. He just disagrees that we're going to have inflation slowing. And that's an interesting difference of opinion.
Do hockey players get a discount on your research?
Maybe. Depends on who you are. I mean, if you're nice to us, we'll try our best to make it happen.
All right, a few questions about Hedgeye. First question is,
Oh, cool.
I guess, go back 10 years. What was the rationale or theory behind starting Hedgeye? What were you trying to kind of improve in terms of what you saw as Wall Street research out there?
Yeah, I mean I call it the old wall. If you haven't noticed, why would you call it that? I mean, the old wall is thick. It's conflicted, it's compromised, it's constrained. There are three pretty easy things to agree with. Conflict of interest are wide-ranging. Constraints, 80-90% of their ratings are buy. And again, when you kind of look at this, I said, why not create something that isn't conflicted, compromised, and constrained, and make something that is transparent, accountable, and trustworthy? Trustworthy doesn't mean that I'm right all the time. Trustworthy means that I'm transparent about a process that you can understand all the time. You can understand when I'm wrong. You can understand why I'm wrong. You can see me say I'm wrong. I mean, you can see me say, 50% of the ideas that we have in terms of stocks or even credits are short. I mean, 50% of the things that we say are sell. You can go back in real-time alerts. We're very consistent with that, even at the trading signal level. So what I wanted to do was create a truth-based product that's accountable and transparent, but also the word Hedgeye is just that. Basically, it's if you could look inside a world-class hedge fund, what would you see? What do they do? How do they do it? Put the eye on top of the hedge, and all of a sudden we have something transparent as opposed to like, ooh, billions, something that's not transparent and scary or whatever. So that was really, what it is. And today, I've been blessed by technology. I mean, I got lucky. I've been lucky my whole life, and that's kind of the way it's gone for me. And I've been blessed with that. But I mean, I got lucky. I got Twitter. I got YouTube. I built a TV studio with the amount of capital that you've never been able to build one with before. So I can go direct to you instead of talking to one of these monkeys on TV. And I also, as we started building the company, I started realizing that, and maybe that's why it's us versus them, a little bit Mac PC. You think I'm unaware of it? Because if I was underwhelmed by the old wall, I was unbelievably underwhelmed by the old wall's media. They are a very poor man's version or woman's version of the old wall itself. And they're just parroting, and the infighting, and just the non-team nature, the unaccountability. That's a very nasty place. And really in the last 3 to 4 years, just to finish the rant, is that the world's kind of, luckily I've again, been lucky, I've landed in the right place. Do people really believe legacy media, linear TV, that they're telling the truth, that they are incentivized to help you achieve your goals? I mean, come on. I mean, let's be transparent and honest about that.
All right, so a lot's changed. When we started the company, 10 people in a house in New Haven.
It was.
We're now 8 or 9 times that with a lot more clients, thankfully. But what, I guess, over the past 10 years has surprised you either in the evolution of Hedgeye or just the evolution of institutional research? One thing that obviously jumps out at me is when we started, Twitter literally didn't even exist.
Yeah, we got so lucky with that.
But what are the things that sort of jump out at you that have surprised you over the course of 10 years?
I mean, a lot of the technological things have obviously, and again, hopefully they continue to surprise me. I mean, technology really powers forward the truth. And again, the truth, according to me, isn't whether I'm right or wrong. The truth is how I articulate it, how I came to the conclusion, what is the data that stands behind it. Right? Again, we're not running around, we don't do investment banking, we don't run money. Some people are like, oh, you don't run money, you're just not good at this then. I mean, 90% of people that run money can't beat the market. So I'd say that there's probably a different question to be asked. And we're actually trying to help the 90% of the people become the 10% of the people. And what surprised me actually the most, out of everything technologically aside, is how much better the buy side can get. The people that are running your money, I mean, if you go to literally the very beginning of the first slide in our process deck, on slide 4 of our deck, I mean, really this is the world that we live in. People may not want this, but this is what it is. We're showing you on the left side the cumulative domestic equity fund flows, or the amount of money that's going into mutual fund managers, long-only managers. You can see obviously the flow is going downward and to the right. And on the right side, you're seeing the cumulative flow, or the money that's going into ETFs. Okay, so what's really happened here, and I think this has definitely surprised me, is the speed at which this has happened. Is the speed at which the place that's losing the money is unwilling to adopt the new methods, technologies, the machine outright, on why the other side is taking the money from them. So that's a big deal. If you don't understand why the machine is doing what it's doing and why everything's operating on a style factor and factor exposure basis that's fundamentally correlating to the rates of change in growth and inflation, I got something that I can teach you. And that's a really humbling thing that I, of all people, was able to come to learn that at the point in time when the industry needs to learn it the most. And that's a lot of people, a lot of active managers. If you want to beat an ETF, you want to beat an index, you got a lot that you need to change in terms of what you do. Like the days of Bill Ackman just getting up and saying, hey, I got one of these, I got a slide deck, I like this stock and I've already bought a ton of it and my friends do too, own it too. I mean, come on, man. I mean, that's not running money. That's pitching me an idea. And by the way, that's another competitive one that kind of scratches me the wrong way sometimes, because we've gone head to head with them on big stocks. Like you used to love JCPenney, $40. I mean, look at what JCPenney's doing today. I mean, at the end of the day, there's a good bull-bear debate on a stock, all right? That's a good, healthy thing to have. That surprised me too, how well my analysts could do. God forbid, because we're not some master of the universe. How well they've done against the buy side's, kingpins, but also how much the buy-side portfolio manager truly needs to evolve what it is that they do and how much we can help them. And moreover, if they're willing to be helped, how much they can help us in return. Don't forget that, as you know, there's tremendous amount of feedback between us, feedback loop between us and our clients, because they trust us. We're not Goldman Sachs. We don't have another side of the trade. It's a very dynamic and evolving relationship, and we're pretty grateful for it.
All right, fast forward 10 years, we're sitting here again, probably both a little chubbier. You're a little grayer. Hopefully I actually grow some hair, although that's unlikely. But how has Hedgeye evolved? How has both the industry and Hedgeye evolved and changed?
I don't know, 10 years is too far away from me. I mean, 11 years ago I had my first child, now I have 4. It's actually even sometimes hard to remember yesterday. I don't know. I just think it's going to be a lot different. I mean, my best prediction is, the plan is that the plan's going to change. I think that you got to really think about the world that way. I mean, if I think that everything that I've told you today is going to be the only way forward, I'm dead.
I guess
somebody's going to copy it, and then if I don't continue to evolve, then I'm not going to be on the front end of it. What I want to do is just, for the next 10 years, continue to push and punch and fight, and don't let anybody tell me that we can't do this. Especially the old wall and its media, and or the old wall itself.
One big trend that we're seeing in our business, which has always been a thesis of yours, is just the empowering of individual investors, right?
Yep.
And to your point on underperformance of fund managers, that's probably something that's just going to accelerate individuals, realizing that they can do better on their own.
Yeah, I mean, that's actually, apologies for that. I mean, I was thinking when you're asking the questions, I was thinking about our institutional business.
Yeah.
For those of you who care, I mean, what I think about markets, we're done talking about that. So if you care about what we're building here, 90% of what we have in terms of revenues are institutional money managers. Like Jonesy runs that business, and we have mutual funds, pension funds, long short hedge funds, obviously. But the fastest growing part of our business is individuals. We have thousands and thousands of subscribers paying, and that's ripping. Okay, and what we're doing with them is like, we're just getting a big kind of like nucks and bear hugs and stuff like this, because I think we're just giving them what they were always looking for. I mean, that to me, that is the part of this that is going to be the most rewarding personally, because when I started this too, I told my mom, of all people, because she could never understand, like, my dad's a firefighter. She was late in life. She became a teacher. Wonderful parents. I was blessed with that too. She couldn't understand how I made so much money as a hedge fund manager, and I couldn't really explain it other than getting stuff right more than I got it wrong. But she asked me so how do you change the world doing that? And I'm like, I didn't know. Now I know, right? Every day I can get up and be little mucker against Goliath. That's what I'm going to do. And we have a lot of people who like that. And it's not just in principle they like it. We're winning. That's why they like it. And we're, hopefully, in the next 10 years we can win more than we lose, and more and more people don't get run over by all these market moves and have all these ex-ante people come out after a move and say, well, we were due for one, I mean, come on. I mean, we can all be better than that. And of all the industries in America, I think this was actually probably one of the most exciting in terms of its upward scope, in terms of its ability to evolve, because you're coming from such a low base.
Right. I think we're going to wrap it up there. Thanks everybody for tuning in. We've had 3 great days of content, and obviously Keith will be back at it tomorrow morning on the Macro Show.